We're going to continue to talk about all these issues with Dubravka Lakos, Chief U.S. Equity Strategist, Global Head of Quantitative Research, JPMorgan. Dubravka, I looked at your background. You're like a math whiz. I think that helps. I think that helps to some extent when we're trying to figure all these things out. Do you ever look at sentiment, or do you just, is it all, can we figure all of this out basically if you do enough quantitative research? Can you come down on the right side of things, just as a philosophical question?
I mean, it's a tough question. There's different angles you can tackle it from, but I don't think you can just look at sentiment. I think you sort of have to look at, obviously, the fundamental backdrop, which I think continues to dictate sort of where the fair value for assets and for equities is over the medium to long term. But then certainly on a more short-term basis, you have various sentiment, technical, more quantitative positioning type measures, and then certainly macro, which could basically swing things, to the upside or to the downside, and you get a bit of a dislocation. But I think it's a combination.
Well, you heard Andrew and Mike talking about whether the move's already been made. It's interesting your overall viewpoint. 4,400 price target on the S&P, so that's a single-digit return, more or less. Everything looks good, but there's been a move made already, but growth will accelerate. It's a synchronized expansion that we're seeing. Interest rates stay low. You point out that some second derivative indicators are peaking, but that's not necessarily like a late business cycle. That's just a return to normal. So I don't see anything here where you're seeing caution flags for something more than just maybe a minor pullback. Everything is on pace, but not exorbitant gains for you.
Yeah, I mean, the growth policy backdrop, in our opinion, still remains supportive for risky assets in general, and certainly including equities. And at the same time, the positioning is not really stretched or in some form of problematic territory. So we do think that there's still a runway. I mean, again, hard to really go into much detail, but what I would basically say is the summer period, sort of the next 2 months, is where I think the market continues to break out. And then, we need to see how the fall and sort of late part of the year plays out. But there you could certainly get a little bit more of a consolidation or pullback as you get closer to some form of taper, and the growth policy trade-off turns a little bit less positive. But I think for now, I think you want to stay the course.
You have earnings per share for the S&P. Estimates are significantly above where most people are, and they're pretty good. 200 for 2021, 225, 245 for 2023. So those would all seem to imply higher stock prices unless rates go up and multiples contract.
Yeah, I mean, that's a good point. I mean, so I think what we're basically going through right now is just basically an earnings expansion story. Last year, you had a ton of multiple re-rating. I think that's behind us. And even sort of if you kind of look at our 2021 outlook that we did now 6-7 months ago, we basically said this year multiple is going to be tough as sort of rates, the inflation narrative starts to kick in into higher gear. But the earnings side, I think, will be carrying most of the weight. And that's certainly happening, and we think continues to happen. And yes, our EPS estimates are above consensus. And if you ask me at this point, do I see upside or downside risk to that? I would probably say some upside risk, because top line growth remains very strong. And most importantly, we continue to see that companies across sectors, cyclical and the more kind of growth sectors, continue to have very, very healthy pricing power. And that's really what you want to see when sort of thinking about the earnings picture further out. So we think the earnings story is not just a 1 or 2 quarter story. I think it goes well into next year and continues to underpin this equity trade.
But in terms of values and cyclicals, you like energy, consumer, and banks better than industrials or chemicals or transports.
Yeah, so I mean, we've been on the value side since last summer, and the trade since last summer has been very binary, if you think, between the value and the growth trade. We have been seeing sort of in the last month or two that, yeah, you want to become a little bit more differentiated. Certain parts of cyclicals still possess attractive risk reward, others less so. So energy, financials, banks, and consumer cyclicals are the areas that we continue to like. The industrial, the transportation, the chemical side is the area that we're just simply less excited. We think risk reward is not as attractive. And then on the growth side, I mean, you have mega cap tech, which remains very fundamentally cash flow wise well supported. Certainly GARP, and certainly could add it into the value bucket. And so that's also an area that we think, people should have some exposure to.
Shepard Smith here. Thanks for watching CNBC on YouTube.